Hi, I'm Tom Huser with the Huser team. Thanks for joining me. Today we're going to go over in detail what a buyer should expect to pay in closing costs when purchasing a home in Las Vegas, Henderson, or North Las Vegas. And really it's very specific because everybody's situation can change. So we're going to run through a couple situations for a financed buyer that's bringing financing to the table with a lender, but also a cash scenario so that you can learn the difference between the two and kind of all the intricacies of it. Okay, so today I'm going to be going over four situations, different situations, and two will be cash and two will be conventional financing. It would be way too much information to also talk about FHA and VA loans. But for the most part, it'll be on these two, and those aren't going to be terribly different, so this would definitely be very beneficial for you to learn from. So the first scenario that I'm going to talk about is we're going to do a $400,000 purchase, and this is going to be a cash deal. And then we'll move on to a $400,000 with conventional financing, and then we'll go to some $800,000 deals. Now, one of the things I do want to talk about is down here, as we get into all these areas, there's going to be a lot of names that you may not be familiar with for these fees. So I took the time and I created a cheat sheet so I don't have to spend the time going through what every single one means. So you could just pause it here. And there's a lot of the definitions for those. And here is a second page also that you could rewind to and just pause. Now, I will touch on some of them, but I won't go into detail on any of them just because the definitions are here. So one of the biggest things that we always constantly get asked by buyers is, how much are my closing costs going to be? And they're really looking for a pretty precise number. The reality of it is we have to say that depends. There is absolutely no way for us to say exactly what your closing costs will be, because especially when we get into buyers, about 65% of buyers right now need a mortgage, and there's about 1,000 lenders out there, and they all have different closing costs affiliated with their mortgages. So that's a wild card there for us. And then the other thing is that the property itself definitely has some different variables that are going to change stuff. And you'll learn about all this as we go through this presentation. So the first scenario here is a $400,000 purchase. Shows the total closing costs are about $2,254, which would mean that this buyer would have to bring just over $402,000 to the closing table. So a couple things that this factors in is the annual insurance is about $600. Now, what I do want to talk about with the insurance, this is, I would like to say, at the average scenario that we see on a $400,000 house is $600 per year for the annual policy. This is like your State Farm, Farmers, Allstate, just that covers the house, from burning down or flooding. I don't mean flooding like rain flooding, but like a pipe burst or something like that. There's a lot of different insurance policies out there for each item. So with that said, this amount can definitely fluctuate based on, most insurance companies nowadays are going off the insurer's credit score. So even though you're a cash buyer, if your credit is not good, then your price could go up. The other thing is if you have multiple homes, multiple cars, your policy can go down. And then also, if there's a specific issue with the property, for instance, insurance companies may need to charge a higher price to be willing to insure it. So for instance, I've seen before where a home has had 2 slab leaks to where the water comes up in from underneath the house into the house and floods it. So when that happens twice in a house, there's large claims put against the house. So insurance companies get worried about insuring it into the future. So that policy could quickly jump to, $1,600 a year. Okay, and then we move into the annual taxes. So a lot of buyers are confused about this. And taxes are, again, there's lots of variables here, but What I will say is if you just pretty much factor about 1% of the purchase price, you're going to be pretty close. So on a $400,000 house, around 1% would be $4,000. Different areas of the town, whether it be Las Vegas, Summerlin, Henderson, North Las Vegas, they're all going to have a little bit of different taxes. So they're really, you see most common from about 0.9% to 1.1%. So factoring around 1 is important. Now, sometimes buyers, when we're showing them houses, will go, well, I kind of want to buy that house over there because, they're both $400,000. And that one has taxes of $2,500 and that one has taxes of $3,500. So the misconception here is that those taxes will remain the same when you purchase the house. That is not the case. So the taxes are always going to be adjusted to the new buyer's sales price, because in Nevada there is an owner occupancy cap. So annually they cannot raise your property taxes more than 3% on your primary residence. So if somebody has lived in their home for 5 years or 10 years or 15 years and real estate values have went up, then what happens is they get capped on that annual cap. So their taxes are actually lower than what they'll be when you actually purchase the home. So I would encourage you to always just consider around 1% of any home you buy in taxes annually as an estimate. Annual association fees. So this is showing that this home would probably have around a $50 per month homeowners association, so that would be around $600 per year. So now I want to kind of dive into the closing costs. So again, this is a cash transaction, so you're not going to see any lender fees or anything like this. This is about as clean as you can get, and this actually offers me a really good foundation to be able to explain some of these items to you. Then you'll see it gets more complicated when the lenders get involved. And there is about 25 people that touch a real estate transaction, and there's a lot of them, of course, on the buyer side, and everybody has to make money. So we'll put a list up here of everybody involved in, so you can see everybody that has to make money. And that's why there are all these third-party closing costs that get involved in every real estate transaction for both the buyer and the seller. So again, I have the definitions there, so I'm not going to go into these in detail. But some of the things that I do want to touch on here are the home inspection. So the home inspection is not based on the price. A lot of these also are not based on the price of the home. Some of them are, but majority are not. So this home inspection here, the price for the home inspection, the average that I see is around $450. Now this changes based on the size of the house, the age of the house. Then you'll see there's a pool inspection down here, whether it has a pool or not, that'll be more. Some home inspectors do infrared imaging to see if there's any wetness behind the walls, and that's a lot more expensive. Now that's like $600. So again, there's a lot of variables. There could be a certain house that's had a room addition on it, and you want to get a structural inspection just to verify that everything was done properly. And also, these inspections are not technically paid at closing. I wanted to put them in here so that you can understand that you would be having these expenses, but typically as a house goes under contract, you're then paying for the home inspection and the pool inspection and any other inspections that you want to do at that time. And that's not paid at closing, it's actually paid prior to closing. Another thing I did not put on here that sometimes does come into play, and what happens is whenever we're working for you on the buyer side, we're always going to be trying to negotiate a home warranty. And that is not like insurance, like a State Farm or something like that. It covers a lot of the mechanical items like dishwashers or air conditioning units, heaters, if the roof was to get a leak, something like that. So typically in about 90% of transactions, we see that the seller pays for that for the buyer. However, right now we are in a low inventory market and the sellers are pretty much in control. So we're only seeing the sellers pay for it about 60 to 70% of the time right now. So that home warranty is usually around $450. So there could be a chance, if it's still a low inventory market, that you may end up having to pay for the home protection plan to cover some of those other items. Real estate broker transaction fee. I've definitely seen this fee, as low as probably $250 and as high as $1,500. Some brokers, it varies on purchase price. So the average that I pretty much see in the marketplace is around $500. That's typically charged to the buyer and the seller. So we have two months of prepaid homeowners association. What this is here is when you're actually purchasing a home, it takes the homeowners association 2 months to get the paperwork all set up to actually start billing you. So they collect this in advance. Now there's another thing here called prorations, and this is something that the seller of the property has already paid for in advance, and the buyer coming in needs to reimburse them for. So a couple examples might be there could actually be property taxes, but I just didn't put that one in here. There's homeowners association, there's sewer, there's trash. So to give you a good example for this is, I have seen sellers that own their homes in cash, and when they January 1st, they pay their homeowners association for the whole year in advance. So obviously that would be like $600 if it's $50 per month. So if you're in the month of May, and May 15th, and this house is closing, the buyer is going to have to reimburse the seller the extra $375 for the prepaid homeowners associations, and we call that a proration, to pay them back. Same thing, taxes can be paid in advance. I've seen sellers pay a year or two of taxes in advance. That's not very common, but definitely, they'll pay 3 months at a time for sure. And the sewer and the trash in Clark County runs with the title of the property, so those will also have to be prorated. Okay, so in our next situation now, we're going to move to a financed buyer. So again, the same situation. I wanted to keep it similar so you could see the difference between cash and financing and understand both. So what we have here is a purchase price of $400,000, down payment of $40,000. Interest rate going today is around 4.5%. So this shows principal, interest, taxes, and insurance payment. And again, I have a lot of these definitions of a lot of these items around if that doesn't make sense. And just over $2,400. So then down here it shows what all is included for that $2,400 payment, which is principal and interest, the homeowner's insurance, that was that policy that was $600 a month, it's divided by $50 per month. The property taxes, again, is divided by 12. PMI, this is because they're not putting down 20% on the loan, they're only putting down 10%, so there's a charge there for that, a monthly charge as an insurance policy. And then, of course, the homeowners association fee monthly. So in some examples, some people do include technically principal. This is PITI, principal, interest, taxes, and insurance. So that's these four. It technically doesn't include the HOA, but some programs add it in, others don't. So there's really no right or wrong way. It's the HOA is not that significant usually. Sometimes, of course, there are big homeowners association fees. So now I want to jump over here. This is where a lot of buyers get confused when there's financing involved in a transaction. So there's three different things that we're going to be discussing. There's the down payment, there's the fixed costs, and then there's the prepaid costs. One of the things I would like to mention is that the prepaid costs can actually go down if you close towards the end of the month, and they're higher if you close at the beginning of the month, and that's for any given month. The fixed cost just means, so they're called fixed costs because, like a loan origination fee, if you've agreed to pay the lender, X amount of dollars, let's just say 1% of the loan amount. me move to that slide here real quick. The origination fee, if you've agreed to pay the lender a 1% origination fee at $3,600, then that's fixed. Whether you close on the 1st of the month or the 30th of the month, it doesn't matter. So that's why those are called fixed costs, because this means that you've already went out, you've spoken to multiple lenders, you've agreed upon a lender, you've agreed upon these fees, and so now they're fixed, and it doesn't matter what day we close on, they're going to be fixed. So then you get these other things called proration. So let's go through some of this. Some of the things that I want you to notice that are significantly different between the cash and the financing is now we have a lot of lender fees that are affiliated with the loan. So you have a lender's title policy, this origination fee, appraisal, credit report, lender's inspection fee, flood certification, recording fee. Recording fees are always going to be loan processing, loan underwriting. Those are all new fees that are from the lender. So as I mentioned previously, there's more than 1,000 lenders out there. So it would be absolutely impossible for us to know exactly what your lender is going to charge and create the perfect scenario for you. So the first thing that we need to know exactly which lender you're working with and what they're going to charge. And then the second wild card is we actually need to have a property, and we need to know exactly what everything is going to be. So it does take us a little time. We can give you a ballpark, but until we get all these quotes from everybody, we really don't have the exact numbers. So let's touch on this a little bit up here. So these are called prepaids or impounds. So when you get a mortgage, the lender is going to want you to impound some taxes and insurance money, so that they've always got a little cushion to make sure that they're making your tax and insurance payments for you. And if you do default, they have a little bit of time with your money to keep paying this stuff until they start the foreclosure process. So 14 months of insurance. So this was that policy that was $600 per month, but they're going to collect 14 months. So obviously they want to make it convenient for them, and they just want a one time per year pay an annual policy, and then they want to have 2 months of a buffer. 4 months of taxes. So usually they pay taxes quarterly, so that's 3 months, and they want to also have another little bit of a buffer there. So they're going to take this at the very beginning of the transaction at the closing table to put that into that impound account with the mortgage lender, so that they can make these taxes and insurance payments on your behalf. So when you're making your monthly payments, you're just refilling this impound account to make future taxes and insurance payments. But they've always got this little cushion here. Okay, 15 days of interest. So on any loan, you're always going to have to pay the interest, because lenders like to get the payment always to the first of the month. So I'll give you an example. In this scenario, we would be closing on May 15th. And to make things easy, we're always going to be on a 30-day month. I know that May does not have 30 days, but just to make it easy, we're always going to say everything is done on a 30-day month. So if we're closing on the 15th, then there would be 15 days of interest that would have to be paid in advance to get through to the first of the month. So to help understand this a little bit better, again, based on a 30-day month, if you closed on the 10th of the month, then you would pay 20 days of interest. If you closed on the 25th day of the month, then you would pay 5 days of interest. So you could see how if you were tight on money, it would actually be better to close later in the month, because there's less money that you have to bring to the table. And that's going to be the same way down here with these prorations. The prorations are always going to be cheaper if you close at the end of the month, so that helps out. So in this scenario, like I said, that since the loan fees are so significant, and we have seen so many scenarios with loan fees, it would be absolutely impossible to quote them all in this short video, because some lenders have no origination fees, others charge 2 percentage points. What I can tell you is, I used to be in the mortgage business, and lenders have to make their money one way or the other. So you're either going to pay upfront fees or you're going to pay in your interest rate, which means you have a higher interest rate and your monthly payments are going to go up and they're going to make their money over time versus upfront. So there's always a break even that you'll have to talk to your lender about to figure out which is the best scenario for you based on how long you intend to own your home. I do want to mention too that this says mobile notary if needed. This is in any scenario that we do. I like to put this in here. So if you are here in Las Vegas when the house is about ready to close and you can go into the escrow title company to sign your documents, then this $200 fee will not be needed. However, if you're currently living out of state and you're waiting for this home to close and then you're going to move in town, or you might be on vacation during the critical week when the loan documents need to be signed and all the closing paperwork. So what the escrow company will do is they will send a mobile notary to you in whatever state you are in, and there is an additional fee for that. So again, that is not necessarily needed, only in those situations. And a couple other things I wanted to touch on was I think we already talked about we did the broker transaction fee, pretty common in the marketplace here. And I'll pause on these definitions for a second, again, in case you want to pause to read any of it, and then we'll move into the $800,000 scenario. Okay, so now here we are at the $800,000 scenario. And one of the biggest things to do is you can jump back and forth in the video to see that everything didn't double. For the most part, it's the same amount of work for just about everything that needs to be done, whether the deal's $400,000 or $800,000 in most of the third-party vendors arenas. So that's why you'll see that a lot of these fees don't change. The escrow fee does change a little bit. It does go up some because there's obviously more money that they're handling and more liability. But when it comes to a lot of the other stuff, it definitely remains the same. So what I did here is to try to make the net sheet here as close as possible. I did adjust some of these over here too. So the insurance policy I adjusted up a little bit because it's a more expensive house. If something was to happen to it, the policy is a little bit more. And typically a more expensive home has a more homeowners association fees affiliated with it. So I increased that a little bit also. So this scenario is an $800,000 purchase price. Shows total closing costs of about $2,800. And then so due at signing, if they were just going to do a cash close, is just over $102,800 pretty much. And you can see all of the fees where you lie there. And then we'll skip forward to the loan scenario. So a lot of people buying an $800,000 house are putting down 20%. So that's the scenario that we're using here with a 4.5% interest rate, which leaves a loan amount of about $640,000. Monthly payment, $4,112. That's principal, interest, taxes, and insurance, and that also actually includes the homeowners association, as you can see down here. So it shows down here the down payment is $160,000. Fixed costs are $13,000 and prepaids are $4,700. Total that they have to bring to closing is $177,000. And then as we get more into the fees, you'll see that a lot of these again do not change. We're doing the 1% origination fee even at this price because that is common for what we see is about a 1% origination fee, but again, this does absolutely fluctuate. We did the Home inspection a little bit more. It was $450 in the cheaper home, and that's because this home is probably larger, more upgraded, more appliances, more bells and whistles. Pool inspection a little bit more elaborate. Also adjusted the prorations for the homeowners association being a little bit more expensive. But the total cost overall isn't substantially higher, just because a lot of those fees are fixed with the third-party vendors. And I do want to make sure that I explain enough about the prepaids and the prorations. So in any situation, whatever price it is, if you have a particular down payment that you've agreed upon with the lender, that is completely separate. And so what that means is if you've agreed to bring in 20%, no matter what, you're going to have to bring in that 20%. Now there's always going to be costs built onto that, which are any of the what we call closing costs, so fixed costs and the prepaids. And the thing that is not addressed in this net out either is the earnest money deposit. So in this particular case, when you get this house under contract for $800,000, you're probably going to have a $20,000 earnest money deposit that you have to put down. So when this says bring to closing $177,000, it is not factoring in that you've already put in $20,000 into the earnest money. So you would subtract that from this number. So the total that you have to bring in is $177, but minus the $20 that you already have in. So that's $157. That does confuse a lot of buyers, and that's also the same situation with new construction. If we're helping you buy new construction and you're putting down money for earnest money and also for upgrades and options, and that number gets to be $50,000 that you have in, well, that gets subtracted from this number here, even in a new home scenario. So hopefully you learned a lot about what to expect as a buyer during the process with closing costs and down payments. And just know that even though there is a lot of variables, your lender is going to be a very good resource to give you the original estimate based off all of their fees. On the real estate side, we can definitely help as long as we've had a good communication with your lender to fill out one of these net outs to get you a really close ballpark as the lender could. However, once we actually get your home under contract to purchase and the lender has been chosen, now we can really dive in and get you the exact detailed statement of what to expect, because we will now have 100% of the information that we need to make this move forward. If you have any other questions, I would love to hear from you. Again, it's Tom Huser, and thanks for watching.